Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Hello and happy December. Today's episode is going to be on taxes and hopefully helping you decrease how much federal income tax you pay. As a disclaimer, I am not a CPA or any kind of tax professional. Decreasing your tax liability allows you to keep more of your hard-earned money. As 2024 is coming to a close, there are a few strategies you may want to consider to do before the end of the year to decrease your tax burden. While taxes are filed by April 15th or October 15th if you file an extension, these filings are based on the actions you took during the prior year. That means that actions have to be done by December 31st, the end of the year, to count towards tax deductions for, in this case, the 2024 year. If you're listening to this episode in the future, then whatever tax year it currently is. Waiting until spring is too late. Employee contributions to tax retirement accounts must be made by December 31st. It is possible that employer contributions can be made during the year that taxes are being filed. For a solo 401k, the maximum employer contribution is 25% of the employee's compensation or the IRS set limit, whichever is less. Since a solo 401k only applies to businesses with a single individual who is both the employee and the employer, and potentially his or her spouse, then the compensation may not be able to be accurately calculated until all the accounts for the year are settled. For this reason, you are able to contribute the employer's portion of the contribution the year you file taxes for the prior year's contribution. This is similar to how you can actually contribute to an IRA or Roth IRA for the prior year or the current year when you're contributing from January to April 15th. However, when it comes to your employee 401k, you need to make that contribution during the year you actually want the contribution in. 401k contribution limits for 2024 are up to $23,000 if you are under the age of 50 or $30,500 if you are age 50 years or older. If you make contributions to a traditional 401k, this can decrease your taxable income. If you're making contributions to a Roth 401k, this will not decrease your taxable income, but there are still tax advantages to doing so. You'll want to listen to one of my episodes that talks about retirement accounts and goes over traditional versus Roth versions of those accounts for more information. While we're on the subject of retirement accounts, you'll also want to do any Roth conversions or contributions to your Roth IRA through the backdoor method by the end of the year. While this doesn't decrease your tax burden for the year, it can be advantageous in the long run. And yes, the backdoor Roth IRA can technically be done the year you're filing taxes for the prior year, but I like to think it's a lot cleaner to just do it the year that you want it to count for. This is another good time to remind you that you need to spend any funds you have left in your flexible health spending account. These accounts are use it or lose it, so if you have any funds left, you'll want to find out how much you're able to roll over to the next year if your employer allows you to do so, and how much you'll want to spend to avoid losing any money you have still sitting in those accounts. Making donations is a great way to help a cause you support, as well as reduce your tax bill. For cash donations, you can deduct up to 60% of your adjusted gross income, or AGI. If you make the contribution by credit card, it counts for the day the charge hits your card, even if you pay it off the next year. For donations of appreciated assets, the maximal charitable deduction in 2024 is 30% of your AGI. You can also make non-cash donations like household items or clothing to places like Goodwill or the Salvation Army. Non-cash donations are deductible at fair market value. Make sure the organization is a qualified 501c3 nonprofit to ensure your donation qualifies for deduction and get a receipt from the organization. In order to get tax deductions for charitable donations, you will need to itemize your deductions on your taxes. If you're someone who takes the standard deduction, then your charitable donations can still do some good for the world, but won't lower your taxes. The next few tips apply to small business owners, which includes you if you have your own private practice or have a side gig. It may also include you if you are a partner in a private practice. Consider putting your family to work in your business. If you have children under the age 18, wages paid to your kids are FICA tax-free. If you have older children or other relatives who may do some work for you, you can hire them as a contractor to do jobs for your business. This reduces your taxable income from your business and helps them build their own income and possibly teach them some entrepreneurial skills. Make sure all the payments are documented and processed before December 31st. You will also need to issue 1099s in January if you don't have them as a W-2 employee. Make sure to maximize any business tax deductions. Bonus depreciation is 60% for 2024 and can be used to deduct 60% of the cost of eligible new or used assets, including vehicles, which were placed into service in 2024. This benefit drops to 40% for 2025 and is currently set to phase out by 2027. Who knows, with Trump as president, maybe we will again see 100% bonus depreciation. You can take bonus depreciation on things like computer equipment and office furniture. These fall under what's called Modified Accelerated Cost Recovery System property, MACRS, with a recovery period of 20 years or less. You can also take bonus depreciation on any improvement to the interior portion of a non-residential building that was done more than 3 years after the date the building was first placed in service. Maybe it's time to put in some new carpeting in your waiting room or office space. Depending on your business's situation, you may also want to consider prepaying business expenses you know you'll have in early 2025. Normally, businesses want to hold off paying expenses as long as they can, as long as they're not accruing penalties or charges. However, if you can boost your 2024 deductions, you're essentially holding on to more of your money sooner. Expenses like rent or utilities could be paid a month in advance. You may have some supplies that you know you'll need, which you can purchase before the end of the year. Just like with donations charged on a credit card, anything you buy on a credit card this year counts for this year, even though you may not be paying off that charge until next year. Another expense you can prepay are state taxes and local income taxes. You can also prepay property taxes. The caveat is that the combined state and local income or property taxes is capped at $10,000. If you fall under the alternative minimum tax, prepaying state taxes may not provide any federal deduction benefit. So that's what I have for you. I know it's not a lot of things, but if any of these things pertain to your situation, it could be beneficial. Remember, I am not an accountant or CPA, so please review any of these strategies with your CPA to make sure you are following the rules to maximize your tax deductions. Some CPAs work with their clients to strategize lowering taxes, while other CPAs take the information you give them and complete your tax return accordingly. If you are a small business owner, there are a lot of tax deductions available, and you'll want a CPA whom with you can strategize in order to decrease your tax liability. As physicians, we tend to pay high taxes. Business owners and real estate investors have the most tax advantages. Learning the rules behind the tax code can lead to significant tax benefits. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. If you're loving this podcast, I would love to hear from you. You can always reach out to me by emailing me at growyourwealthymindset@gmail.com. And I'll be back next week with another episode. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.